We're beginning a paradigm shift. A paradigm shift is a shift from a mindset, one mindset, and positioning of that mindset to another mindset and another positioning of that. So, for example, the mindset that we were in was that you have low inflation, and when you're owning bonds and you're owning cash, or you are operating one way, and you don't worry about that, and companies don't worry about it in their inventories, having larger inventories, or homeowners don't worry about inflation as much in the purchases of the houses and so on. Once that shift begins, it causes a reinforcing dynamic. It's like everybody is long bonds. We've been in a 40-year bull market in bonds. And so it's been fine to have. And when that shift starts to take place, you see behavioral shifts that reinforce that cycle in the paradigm. So for example, when there is the selling of bonds, that it makes it more inflationary in and of itself, because the amount of debt that has to be sold is not just the deficit, but also the amount of debt that's being sold is those bonds. So now interest rates have to rise a lot, or the Federal Reserve has got to come in there and buy more. And then you get wages. People make wage settlements that and such things. So a paradigm shift is beginning to take place, and that will be also self-reinforcing. And it's taking place in this context of the conflict, which then creates the breakdown of efficient systems. Each country wants to be self-sufficient. It needs to protect itself. And in being self-sufficient in that way, then you have less efficiencies in the system. And all of that becomes self-reinforcing. So it's all happened before. It's all happened many, many times before. That's covered both in the video and the book. So it's, yeah, I'm concerned about that. Well, there's two ways of dealing with debt. You pay it back in hard money, or you pay it back in soft money. You pay it back in hard money and you have a problem. You have a depression. So throughout history, whenever that was done, pay it back in hard money. Eventually, that was abandoned and you print money. That was what 71 was. That was what March 1933 was. And so I think that what you have to think about is the value of money. How much money does one have in debt instruments? And do you want to own that as an asset? I think they're bad assets. And so, and then how do you diversify? And the system also has to deal with what is money? What is money? Is the dollar going to remain the same sort of reserve currency? And then you see the development of alternative monies. We're seeing a variety. I think different types of money will compete with each other in the environment we're in. Some, maybe it's crypto, maybe it's gold, maybe it's other things. Maybe the digital renminbi competes with the US dollar. We're going to come into an environment because everybody thinks that think about how much money is being stored in debt instruments, those debt assets. Think about how poor those returns are. So that kind of a shift, I think, is very important. It's funny because, you know, everybody says, okay, there'll be 7 increases or something like that, and that sounds like a lot. But you're taking interest rates up to something like 2%. And that 2%, which starts to squeeze the capital market, starts to make it more difficult for a holder of equities, because the equity, when you raise the return on bonds and you raise the return on cash and you tighten money, then that makes other assets less attractive, such as risky assets, particularly long duration assets like tech stocks and the like. So you produce that squeeze, yes, but that's still only at 2% or a little bit over 2% with an inflation rate which is considerably higher than that. We've had a 7% inflation rate, and we'll probably settle, it'll be a 5% ish or something. And so you're still losing that money to inflation. People are. So what you have is enough tightening by the Federal Reserve to deal with inflation adequately is too much tightening for the markets and the economy. So the Fed is going to be in a very difficult place a year from now as inflation still remains high and it starts to pinch on both the markets and the economy. So it's like, here's the problem. If you're borrowing more money than you're lending and you have a lot of debt, you either are going to pay back in hard money or in soft money. And so it creates a very difficult trade-off. So what can you do? Do you spend less money? So that the trade-off becomes more and more difficult, and that's what brings about a stagflation environment, because they tried to navigate between those two undesirables. In other words, they want to contain inflation, but too high of an interest rate that's good enough for inflation causes too much economic environment. So what can they do? No, they're in a position already because of that dynamic, spending more than they're earning, creation of a lot more debt, and a lot of other debt, which one man's debts are another man's assets, and that as the holder of that assets is losing money. Imagine holding a bond now, and look at how much money is in bond funds and cash. Okay, not only in cash, you don't get any return to compensate for the interest rate, and in your bond fund, you get negative returns. And how's that feel? So you're going to continue to hold those bonds in that bond fund? It's a dynamic that they have to deal with that is really beyond their capacity to deal with it. They can't change those fundamentals. All currencies have a lot of debt. And so when you look at one relative to the other, there will be a lot of printing. I mean, currency equals debt. And when you hold a currency, you're holding a debt instrument. And so all of those will decline in value relative to other things. Now, will the dollar decline more than other currencies? It's almost certain that we're going to come into this environment. We're in this environment in which there's a shifting of those currencies. So you're going to see more of China's renminbi being used. You're seeing India have a direct link with Russia on the currency. So we're in an important change in the currency. But how that is a store of wealth is a different question. So a currency is a medium of exchange and a storehold of wealth. And its storehold of wealth is now a problem, particularly for the dollar, but it's also a problem for other countries. So that's why you have inflation. As money goes into other things and the cost of borrowing is so low relative to the inflation rate, then it encourages the borrowing of money and the sale of money. In other words, not holding financial assets like that. So that's, yes, I think you're changing the nature of what money is and what the dollar is as a storehold of wealth. You have to have an economy in which the people believe that you have a fair system, and you have to have productivity. So I would say the most important thing is the redistribution of opportunity to make people productive and to eliminate the internal conflict, or to reduce the internal conflict, which can be so disruptive. When you see large wealth gaps, and at the same time you see economic problems, you have a lot of internal conflict, and that internal conflict is bad economically and it's bad socially. So yes, I think but it's not just the wealth gap, it is the productivity level that results. So yeah, the wealth gap is a problem, the opportunity gap is a problem, the productivity that allows, and productivity can be measured in what you earn relative to what you spend. So yes, all of that, that gap is an issue, and it's certainly going to be a political issue. So when we talk about markets and the economy and all of these things, we have to realize, for example, that there's a great internal politics, populism of the left and populism of the right, and the polarity is becoming greater. It's entirely possible that neither side accepts losing the 2024 elections. In other words, that we lose, the democracy, in a sense, you could find ourselves in a situation where the rules no longer apply because of that type of internal conflict. Internal conflict will have a big effect.